This is Eric L. Dunn at the Mindset Disruption Strategy. Let's talk a little bit about tax strategy. More specifically, I want to show you the three tax strategies that most people are completely missing in 2022. Before we do that, if you're enjoying the content, if you're enjoying these videos, it certainly would honor me if you would go ahead and click the subscribe on the page, and then make sure to hit the notification bell so that you can get up to date every time that new videos are coming out. So there are three tax strategies, that most people are completely missing. Now, not every single one is going to apply to all of you, but I think when you start taking a look at these, you're going to open up your mind to going, oh my goodness, I didn't even think about at least one of these. One of these is going to pop out, and maybe all three, maybe two. But when it comes down to paying tax dollars, here's what I know. Every excess dollar that you pay is wasted. It's dollars you could have held on to. It's dollars that could have stayed in your pocket or stayed in your control and could have continued to work for you. But because you didn't put the right tax strategies or right tax planning in place, now the dollars are gone. So let's start with tax strategy number one, which is giving appreciated assets. So let me set up the scenario as it's kind of listed here. Let's say that in your heart and in your mind, you're like, you know what? I want to make a $10,000 charitable gift. And you don't even stop to think about it. You're just planning to pull out the checkbook, just write a check and give it to the nonprofit organization. But if you look more closely at your investment portfolio, what you'd find is that you have investments worth at least $10,000 that are subject to capital gains taxes if you're going to sell them. Maybe it's a company you've held for a long, long time, or one that went up really, really quickly. I mean, if you were to look at how the stock market has performed the last 2 or 3 years, even with temporary volatility, it's done really well. So more than likely, you're holding on to stocks that if you were to sell them, you're going to pay capital gains taxes on. But what if there was a different way? What if there was a better way to take advantage of this? And that's exactly what we're talking about. So here's what you do. You go look inside of your investment portfolio in a taxable account, and you find $10,000 worth of stock, and you gift the stock directly to the charity or nonprofit of your desire. Now, the majority of nonprofits, especially the bigger ones, are going to have a facility for you to be able to do this. Sometimes you'll run into issues on the smaller ones where they're not as familiar with it, but reach out to a local community foundation or other groups, and they can help you figure out how to get this done if your nonprofit is not aware of how to exactly receive these. But you make a gift of $10,000 on the stock. Why? Well, first, you're going to get a $2,500 tax deduction. That was what you were going to get already, even if you made the cash deduction, but you haven't lost out on anything, right? You got exactly the same tax deduction, but here's where it gets really beautiful, because the nonprofit now sells that stock for $10,000 and they get $10,000 back. The IRS and the rules say when a charity or nonprofit sells an asset that might have capital gains taxes, they don't have to pay it. The charity or nonprofit is exempt from paying that capital gains tax, so they get all $10,000. The other benefit, in addition to you getting your $2,500, is we said you were going to write a check, right? You're going to write a check to the nonprofit. Well, that means you've got $10,000 in your bank account. Go directly to your brokerage account, and if you like that company, repurchase that stock. Or if you've been meaning to diversify, repurchase something else. But you've now established a completely brand new cost basis. And guess where the capital gains taxes went? They went to the charity and the nonprofit. They're the ones who got to use those dollars instead of paying it to Uncle Sam and the IRS. So what does this look like? Well, gifting the stock washes out $1,500 in unrealized capital gains taxes. It washes it out from you, puts it in the hands of the nonprofit. You get your $2,500 of current income tax savings. And I went and calculated it, just 5%, that $2,500 and that $1,500 together combined for a growth of $19,000 in 25 years. And that's a lot of growth happening on a small level just on being more strategic and thinking through how you're doing this. And then from an optimizing giving standpoint, the charity realizes $10,000 of giving And again, they sell that stock without paying any capital gains taxes. This is the one opportunity almost everyone listening to this video can take advantage of. And can I tell you, it amazes me how many times I have conversations with people and they're like, I never even thought of that. I've never even heard of that. This is low-hanging fruit opportunities. But let's step into the next one. The next one that you may be missing out on is what we call an enhanced income trust. Now, there are 5 variations on this. I'm simplifying this way down. If this looks like something that you might be interested in, get in touch with your tax professional, get in touch with your financial professional. You reach out to me in a private message, but don't go and try and do this on your own. I want you to just understand conceptually what's happening in the opportunity here. But here's how it works. Let's imagine you have an asset that pays very little income, but has a large capital gains taxes and it needs to be sold. 2 primary examples we've seen of people who have used this. One, business owners who are sitting in front of a business sale, or people who've been holding raw land that has appreciated quite a bit and they're ready to sell it. It's an asset that has not been something that's been income producing, but you need it to be income producing in the rest of your life. You need to turn it from non-income producing to income producing. Those are the 2 situations I've seen this used quite a bit. So here's what happens. You take that low or no yield capital asset and transfer it into an enhanced income trust. Now, real quick, especially for business owners who are selling a business, you don't have to transfer all of it. Even if you're selling real estate, you might be just transferring a portion. And this is where working with your financial professional to really understand what you're doing is you're taking this low or non-producing asset and turning it into a producing asset inside of the enhanced income trust. Because this $500,000 now becomes, you get an automatic tax savings of $40,000. So just for putting it in there, you're going to get the tax savings. But the other thing that happens inside of this trust, when the asset is sold, 0 capital gains tax, 0. And it pays a lifetime income to you and your spouse for the rest of your lives on this variation, right? $25,000 coming back on an annual basis in income on something that wasn't producing income before, and the capital gains taxes completely eliminated. How does this work? Well, the way that this benefit, you get the tax savings up front and you get the lifetime income and you get no capital gains tax on the sale, really centers around this idea that when you pass away, all $500,000 is going to a charity or nonprofit. So to take advantage of this needs to be money that you're not planning to leave to your children or your grandchildren. But there are ways to supplement and complement this if that's your desire. There are ways to make all of this happen. And it's a beautiful scenario and a combination if this is a good fit for you. Because look at everything that happens. There's $500,000 going to the nonprofit. For prioritizing value, you're getting a lifetime of income for you and your spouse. You're getting $40,000 of current income tax savings, $40,000 in your pocket that you're not sending to the IRS that can grow and grow and grow for you for the rest of your life. And in this instance, we avoided over $100,000 in capital gains taxes by putting the asset into the enhanced income trust and optimizing giving by having $500,000 of deferred charitable giving that goes to a place that you love and you care about once you pass away. This is a powerful, powerful tool. As I said, this is a tool I've watched a lot of business owners. Now you have to do this before you sell the asset. So let's say you had a piece of real estate or a business. If you are already in the process and the thing is sold, you're too late. Not that you can't set this trust up, but the benefit of getting rid of the capital gains taxes. So this is something you need to be talking to your professional and to your team about before you enter into the sale transaction. You want to put this on your planning list beforehand. The third and final one that I watch a lot of people miss out on is what we call the accelerated inheritance trust. So the accelerated inheritance trust, this is the situation this is used in. So let's say that you've got a piece of real estate that pays income, but it's income that you don't need, right? It's excess income that's coming in, that's just building up your estate or building up, and usually maybe you give it away. whether or not you give it away, understand that the fact that you don't need that income is causing you to pay more income taxes than you need to pay. And if this is a property you'd like to get to your heirs, this is a perfect tool and a perfect solution inside of this scenario to help pass it down. And I'm going to show you there's some really cool things that begin to happen inside of this tool. So you take this high growth or high income capital asset. Again, it doesn't have to be all of it, but it's assuming this situation is $500,000, and you put it into this accelerated inheritance trust. Remember, it's paying income. It's bringing excess into your life that you don't need currently. What you then do is for a period, and it's going to be measured differently based on what you're looking to do. Based on this example, greatly simplified, it's annual income for 12 years of $35,000 going to a charity or nonprofit of your choice. Now, one little caveat in here, you're not getting a deduction for this. On the flip side of this, remember, it's not coming into your income taxes either. So it's not increasing your income taxes. It's not decreasing them because you're making the charitable or nonprofit. Here's where the benefit really comes in. After this period of 12 years, based on how all the calculations are done, this asset passes directly to your heirs, $500,000. The charity over that 12-year period ended up with $420,000. And then your heirs, when this is all said and done, got $500,000. No estate tax, no transfer tax, no income tax. It just dropped down to them. What a beautiful situation. Look at what's happening here, right? You're passing $500,000 tax-free to your heirs. Secondly, you're avoiding paying the excess income tax on this $35,000 on surplus income you don't need, and no gift taxes. And you use your current charitable giving to pass assets to your heirs tax-free. So it's money that's going to a nonprofit tax-free. These three strategies have all been greatly simplified, but I'm going to tell you, these three can be powerful places of leverage inside of your life to increase tax savings and build your generational wealth over time. And all you need to do is take a step back and just think about, is there a better way to do this? Is there a better way to think about it? Because when we ask those questions and we say, hey, maybe one of these strategies can help me, we make an impact on today, tomorrow, and for generations to come. And good tax strategy can help us build what will last and make a kingdom impact and build generational wealth. Thank you so much for joining me. God bless you.